Hello and welcome to LiveSquawk's Market Talk. Today's episode previews the impending US CPI inflation report covering May. Last month's reading showed scant evidence of any tariff headwinds, but economists look for stronger signs of the trade war reflected in costs for this month's release. To help me figure out what to look out for, I'm joined today by two market-savvy experts. Firstly, a regular guest on Market Talk, Beat Nussbaumer, founder and CEO of Macro Beat. He's an FX macro trader, research and FX tutor, and has been a market professional for nearly 40 years. And we're joined, luckily, by a very special guest, Jeffrey Hirsch, CEO of Hirsch Holdings, publisher of Almanac Trader, editor of Stock Traders Almanac, and his quote, "Those who understand market history are bound to profit from it." Some wise words there. A warm welcome to you both. Before we get into, I'll bring you guys in a minute. Just a quick disclaimer here. The content provided on this channel is for the informational and educational purposes only. I am not a licensed financial advisor, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We're not responsible for any losses or gains that may result from following the content on this channel. Gentlemen, I'll come to you both for your opinions shortly, but welcome to you both.
Good morning,
Hey,
sir.
Good morning. Thanks for having us.
No, pleasure. But I want to just go through some of what we're looking for today, some bank research, and give our listeners the sort of median estimate ahead of today's release. So let's crack on with that. So I've got a note here from National Bank of Canada. In their preview note, they're looking for 2.5%, or the consensus is 2.5% annual print for a headline CPI from 2.3%, 2.9 for the core versus 2.8. So we're looking for it to tick up again after last month's, I think, surprise dip potentially. But economists at National Bank of Canada said a negative contribution from the energy sector, where gasoline prices fell, could limit the headline price increases to 0.1% this month. However, this would not prevent the 12-month rate from rising by 0.1 to 2.4% due to the negative base effect. Meanwhile, core prices may have increased by 0.2% on the month, driven by acceleration in the goods segment. This would translate to a 0.1% increase in the annual core inflation rate, bringing it to 2.9%. So that's the view there from National Bank of Canada. A quick look at the consensus here, if it comes up, yes. And we're looking at, again, let's get this up, because my eyesight is getting so bad.
It's there. It's up.
Oh, you can see it. Yeah, I just can't see the writing. 1 second. I've got to wear glasses. So the consensus estimate, year over year, 2.44%, if we go to 2 decimal points. Month over month gain seen at 0.18 or 0.2% rounded. Year over year core seen at 2.9%. Month over month core seen at 0.28%, with UBS near the top end of that range there, alongside JP Morgan Asset Management for 2.4 headline year over year. And we're looking at the other end of the range. Goldman Sachs actually looking at 2. So they're the bottom end of the range. The top end of the range, near a 2.5 from likes of Goldman Sachs and Morgan Stanley for that year over year figure. So if we get into the details now, Beat, I'll come to you first on this. What are we looking for? What are you looking for from today's number that would trigger you to sort of put on any new sort of positions or trades, for example?
Yeah. Hi, Harry. Yeah, thanks for having me. To be honest, it might sound very, very boring, but it's the first time that I'm very light on risk heading into the CPI. And this is less to do with the CPI, but just with the sort of situation in the market after having had a multi-week down in the dollar, the sell America theme that we had in the past many weeks. And it just started to feel that the dollar in the last week and a half just constantly needs negative news in order to actually sell off. So what I'm a bit worried about, and this goes beyond the CPI as such, as I think the CPI at the moment is just really only a piece of a large puzzle with tariff impact, trade war, Fed not going to cut, blah, 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 all the other negatives. So these sort of basic stagflationary comments that the Fed is consistently making with the risk of higher unemployment, higher inflation. So yes, they don't talk the yes word. Yes, probably it's a bit different than it was in the UK as growth comes from a higher level. So yeah, probably technically we will not be in a stagflation that quick, but it's where we're kind of heading. So my worry is there is a short-term element and a macro element. The short-term element, I think the market is short dollars, no doubt about it. The story has been around for long enough that the market is short dollars. And like I said, it needs a constant kind of refresh of bearish stuff. So if we were to get a stickier CPI today, I said to someone yesterday, you could tell me the number, I wouldn't know what to do. Why? Because there's two angles to it. Either we get a sticky CPI, yields go up, the dollar squeezes, finally we get this sort of short-term squeeze in the dollar, and maybe back to levels that are probably make a little bit more sense to get short again. Or B, we do get actually a stickier CPI, yields start to go up, but then the equity market starts to be under pressure, and the element of people starting to think about stagflation. And quite honestly, Harry, that's exactly what I don't know what the market's gonna actually do, right? And so what my tactic has really been, I have some peripheral risk, but in dollar terms, I'm more or less flat for the first time in probably this year, and using today's CPI more as a reaction function than a preemptive function, saying, just keeping the bets open whether the market is going to go for this, dollar squeeze, the DXY, the 2025 downtrend keeps falling, so the line is not that far away. So we could get, one of these accidents where suddenly we head into summer and the market is getting squeezy and whatever. While the broader narrative, as I said, I have no doubt that the dollar is going to weaken through the year. I think the theme of Sell America is not going to go away. So the broader themes are here, but I'm a bit worried that today's CPI could just be that little, game changer in the very short term. Suddenly could turn into a squeeze in the dollar if the market doesn't trade stagflation, and I just don't know if the market is ready to trade stagflation.
Okay, thank you for that, B. Jeff, just as you're on that side of the pond, you're in North America. What are your views on, firstly, on today's inflation report, but then on the wider connotations and in the markets you look at ahead of around today, and we'll talk about the more general environment as well over time.
Well, first of all, thanks for having me on, Harry. Appreciate talking to you guys over there, and I do value the perspective from across the pond. I had another gentleman from the UK, Alex Berglou, he's Greek, but he was on. I got a little perspective on my podcast from him about what's going on, from the European view. But for me, today's number is, probably not a big deal, probably a nothing burger. But I think you made a good point earlier when you said perhaps a surprise dip. You put up the consensus numbers. I looked at the Cleveland and the Nowcast, and they've been pretty accurate. And they're at 0.13 month over month and 2.4, which is right in line with that median. And the thing that we're looking at that probably increases the odds a little bit more to the surprise dip would be that energy prices were pretty flat in May, and that seems to be the biggest driver of inflation. I know we're all hyped up about the tariff and trade wars, and there's some news today with China and all that stuff, but energy prices are really what drives inflation, and we're leaning with the Cleveland Fed, 0.1, which is in line with our CPI and inflation projections. That keeps us heading in the right direction. So unless the numbers, real sticky and a surprise on the upside, I'm not sure the market's going to react much to it. I think the bigger news out there is with for the market today is probably China and trade. I'm not reacting to this either way. We're pretty defensive with the Sell America trade that you guys are talking about. We've been diversified into the currencies, the euro, the franc, and the yen. We're also getting into some of the international funds. We are in our, what people call the sell in May period or the worst 6 months. I mean, I'm a fan of buying in October and getting your portfolio sober and repositioning in May, which is what we've done here.
Right.
So we're still long the NASDAQ and the Russell, which are stronger here in June, but especially after the big May, the rally you were talking about, post-election year patterns for the U.S. markets in June are kind of flat. So we're expecting a little bit of consolidation and correction, or not necessarily correction, but pullback here in June before we get what we call the Christmas in July mid-year rally for NASDAQ and the tech stocks. So, yeah, I mean, America, I wouldn't sell America short forever. There's definitely a push here with what's going on to diversify and rotate out of there. There's a lot of other, innovation and growth going on in the rest of the world. So I think it's definitely in one's best interest to be a little more diversified these days, especially with the European markets doing so well. But I don't think there's a big reaction here to the CPI. I think it's flat. I think it's around consensus and what the Cleveland Nowcast has there. And if anything, a little surprise dip like you were sort of sensing.
Okay, good. So what I'm hearing from you both is a defensive tone here generally, and towards today's inflation read, you're looking for something exceptional to bring you out firing, basically.
I think what Jeff said was interesting. So in case we do get a surprise on the downside, because I think the market is really geared up for stickiness and finally, tariffs gonna show up, blah blah blah. If we were to see a downside surprise and that sort of these elevated prices are not coming through the pipeline yet, that could actually give the dollar another knock. The dollar was sort of, especially if you look at dollar yen has bottomed out last week on the back of the reduced taper story from BOJ, the MOF cutting duration, blah 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 blah. So we had a bit of already a bottoming out. We have Jeff mentioned the China-US talk. Well, probably it's not a trade deal; it's more a handshake last night. But at least
it looks like they're kicking it down the down the road a bit here. It didn't look like much.
Exactly. So to be honest, it's glass half full stuff, which is probably okay for equities in regards to, it's not 145% tariffs. We're talking blah, blah, blah. But I think the market last night was very underwhelmed, which makes sense because what we can see is these talks are going to drag on. And as you say, going to be kicked down the road. But it's hard to be negative about it when they talk. So I guess it's a lot of these ifs and buts and stuff out there right now. But in an FX sense, given the dollar has sort of tried to bounce a bit, a downside surprise in CPI could definitely challenge the top side in the euro because the market is willing to put the foot down if it were to work. They're just a little bit on a vacuum as we've seen this week where the range is just very tight. And it seems the market is similar, or the sort of short-term market is similar to my feel that, it's better maybe to wait and react rather than preempt.
Yeah, well, just to that end, quickly, the overnight, to those who weren't aware of what's happened overnight, US and China negotiate. This is courtesy of Deutsche Bank's Jim Reed and their notes on this. Basically, US and Chinese negotiators have said they've agreed on a framework of how to implement the agreement reached at talks in Geneva last month. That does sound very long-winded and very vague, if you ask me. The main details came from Commerce Secretary Lutnick, who said that we do absolutely expect that the topic of rare earth minerals and magnets will be resolved and that export controls implemented by the US should come down as China approves relevant export licenses. On the other side, China's trade representative Li Chenggang said that US and Chinese delegations will now take the proposal back to their respective leaders, with Lutnick noting that once the presidents approve it, we will then seek to implement it. That to me sounds like a long-winded process, and therefore the rumblings, the undercurrents that we're seeing from the president, whether he decides to come out and say something positive in terms of the talks, or whether he then imposes different sanctions, because they didn't really cover, from what I understand, they didn't really cover the drug, the fentanyl issue with any kind of depth, and I think a lot of people are looking for that, and potentially that's still a cost that President Trump could use against China at any point. So, like you say, look on the optimistic side for this and hope for the best, but fear for the worst, because that's what we've been used to over the past 4 months, I think, since we started on this. So fair play on that. I just want to get your views, like, and you've both touched upon it, but looking at the wider picture, looking at the Fed, for example, and monetary policy, obviously they're in a blackout. For anyone who doesn't know, they're in a blackout period now for 10 days ahead of their next decision mid-June. We'll come to you first, Jeff, on the Fed and its current policy path. Today's CPI aside, do you see much change over the summer? Do you concur with the markets that we're looking maybe for one more move this year from the FOMC?
I don't see them making any move before September. I mean, there's a bunch of things there. Number one, there's data just coming in. What we're seeing, what we're talking about this morning with the CPI, this is still not really seeing the effect of anything. This tariff discussion and trade war and negotiations is all going to take a lot longer. I think the market has shown that it's pretty desensitized to this tariff war now. We had the reactions, the downdraft, the updraft, and now it's back to seeing what some of the hard data and not the soft data is. I wanted to, just to answer your question about the Fed. First of all, there might be some political bias there. There is clearly a data-driven wait and see. So maybe one, I guess you're looking at the CME futures. I stopped looking at that because it wasn't really telling us anything other than all bets are off on a rate cut. With the U.S. economy doing pretty well, the labor market looking pretty strong, inflation pretty tame. They're in no rush to do anything, and really the Fed doesn't tend to do much unless there's a fire to put out, and there's no fire here. So until something breaks, inherently they're late. They have to be, because they have to react. They can't anticipate everything. It's not what they're built for.
Yeah, that's the right model. That's the right that should be what is sent. Well, maybe they're
supposed to be guardrails. They're supposed to follow the bond market and put some guardrails in there if things get out of whack, and they're not really out of whack right now.
I agree. Pete, what do you think?
Yeah, to be honest, I could not agree more with it. I think the where we are at least in the FX world, because of this sort of window of sell America, even though Jeff may not like it, but let's say the kind of the bond.
I sold some. I bought some foreign.
Just keep it quiet, Jeff. Let's not tell the world.
No, but to be honest, because we had this sort of pressure on the bond market anyway, and we had this sort of drift high in US yields, and then we had the correlation break for the first time in decades, where we actually see higher US yields and a lower dollar, which is obviously the characteristic of the sell dollar trade, sell America trade. And so the whole moves in the bond market seems to have created something where the FX market, it sells dollars if yields go down on weak data, and it might actually sell dollars if yields go up on fiscal worries. So we kind of not that close to the Fed anymore at some point. The market here, in my opinion, has given up. 1 cut, 2 cuts, no cut. Who cares? We're watching 10-year yield. We're watching 450, 460. We watch what Besson is saying, because he still has to roll $9 trillion at some point. This whole, actually, maybe, very interesting to see last night they floated the idea that Besson might actually be a good candidate to replace Powell next year. So it's kind of
which was denied. Which was denied.
Yeah. So
that would be interesting. But you made a comment there, if I may, just about the 10-year. One of the things that we're starting to look at right now is the 30-year and the 5% level. So that's something that the market's looking at and concerned with.
Correct.
The 10-year has been talked about for a long time, and it's bounced around there. And that 30-year it's almost it's what, 4.96 right now.
Yeah, I think you touch an interesting point, because obviously all the headlines also been around 20, 30, and 40 years when we talk JGBs. There's obviously 30 years in the UK with Rachel Reeves just holding a spending review. So yes, totally agree. There's a lot of focus on this long end, which obviously is connected to the whole various debt issues out there. The reason I think why the FX market still cannot totally let go of the 10-year is because this is the sort of benchmark from Besant. That's a benchmark from Trump when they sort of came into office to actually, for Trump 2.0, the measure is 10-year yield. What Trump 1.0 has been the stock market. So kind of what I'm trying to say is the Fed's for FX right now, right here, is no story, because you can see the ECB has been dovish cutting rates and the euro is at the high. So we had a complete different turn. And I think what Jeff mentioned is actually what's going to go on. I'm not talking about the dollar collapse or whatever, but I'm talking about some serious thoughts in the world about where to put your money. We can raise one more issue or one more topic, which is JGB yields, long-term yields. I mean, we spoke about it in the past. Suddenly, the GPIF, the pension funds in Japan, get some really decent yields internally. We've seen a lot of bonds and bonds selling from Japanese. So the money is flowing back home to some extent. Again, it's not going to be something that they dump everything they own abroad. But there's a new world coming. It's not happening in weeks and months, but there is a new regime out there, which is less Japanese money that is financing long end abroad. And that is just a fact, no matter how we want to turn it. And so that is something that is actually sort of in the FX market almost a bit more than, I don't hear anyone talking about the Fed. No one could actually care about the Fed, right?
I get that. But just on that, just to anyone, again, who isn't aware, this week we've got Treasury auctions of some long end 10 and 30-year US debt. The 30-year one obviously will be of a lot of interest for the reasons the two guests have intimated. A note, it says that US 30-year bond auction will be closely watched post the long JGB auction weakness. So I get your fact that you say that money's coming back into Japan, but it's not going into the Japanese long end, it would seem at the moment. That, the JGB isn't performing, I don't think it's particularly well. So
to be honest, that was actually a surprise, because that is where the whole story got interrupted about this sort of anti-carry, or call it repatriation. That you would actually have thought that, especially that Ueda or the BOJ, I'm not sure he's actually the legal side of it, but that the GPIF is now allowed to directly bid in JGB auctions. Now, of course, I have no clue, whether they already own everything they can own or allowed to own, or if they can actually own more. But, you could see how Ueda, which came in to actually reduce the footprint of the BOJ in the market, to actually lining up people they can or could offset some of the taper they have to do, right? So that's why I say there's so much going on out there right now, which is unprecedented, which is new versus what we sort of experienced in the last, 10, 20 years. I mean, having Japanese hiking rates, having yields where they are, and the whole changes that they may or may not occur is just, massive. And I think that is where I have a lot of focus right now. And as we all maybe not yet know where the flows will end up, but you're right. I was surprised that the long end in Japan didn't actually benefit more.
Yeah, it's very interesting on a number of levels. Listen, I wanted we're not going to labour the point, because we do have the report out in just over half an hour from now. So I'm going to start wrapping things up there. Just to quickly go back to today's number, I understand the wider picture, but for those who want to trade around today's number, last month's measure of consumer price growth reflected minimal impact from tariffs, and forecasts expect only a modest upward adjustment in May. Just to give you the poll here, 2.5%. Some people looking for year over year in May. Actually take up 0.2 of a percentage point from April. Core, which strips out volatile food and energy, is expected to increase to 2.9% versus 2.8%. So the general feeling is we are looking for this to uptick. Analysts at Morgan Stanley expect a modest uplift from tariffs. They say company reports and surveys suggest some firms began adjusting prices in May, while others have announced increases for the coming months. We anticipate firmer prices for apparel, new cars, and other heavily tariffed goods, such as household appliances. This tariff-driven push is partly offset by another soft print for used vehicles. And also another feature within this report, owner's equivalent rent, or the OER category, closely watched by economists, is expected to have eased again last month. Again, this is from Citi this time. There's been some surprising firmness in the OER rate in recent months, as said Citi Research, but we expect more slowing in May to 0.28% month over month, with a 0.3% increase in primary rents. Strength in March and April may reflect that OER typically slows the most during these months, implying a larger seasonal adjustment boost. So again, anyone wanting to trade around today's CPI report out in just over half an hour, those are the points I think within today's report, especially on the OER front, that you may get some movement around. But on the wider scheme of things, as our two guests, Beat and Jeff, have said, not really looking for anything unless we're going against the grain with this number, and we would see a surprise again reduction from expectations as opposed to a tick up as seen by.
I think the risk is more for the tick up, Harry. You know, down I think would be positive, and the market would just continue on its trend. But if it's much tighter inflation or much stronger inflation, that would be the issue.
Good point. Thank you, Jeff. Beat, is that before we wrap things up? So from your perspective here, you're defensive. You're staying as an intraday trader. You're staying on the sidelines unless you see something of particular interest in today's number.
Yeah, to be honest, I even closed some of my macro dollar short for the time being, just because of the odds right now. It just seems to be, you know, the momentum is just sort of running out of steam a little bit on the dollar side, which I mentioned earlier about, you know, we seem to need constant negative news, and we kind of drying up on the negative news side. So that is just, you know, fast money, short dollars. There's no doubt about it. And so there's some upside risk there if we get a sticky sort of number. But maybe if we get a weak surprise, we have a last roll of the dice. So I'm definitely rather trade a weak number to see if we can give the dollar another push. A stronger number, I might actually just, like you said, be a little bit defensive, see what happens. I'm a dollar rally seller rather than feeling I need to be involved right here, right now.
Fair play. All right, guys, listen, thank you very much for taking part in today's episode. Very informative as ever. Yeah, just for those looking to trade this, 8:30 Eastern time, we'll get the inflation report out. You can listen in at LiveSquawk.com if you have a license. If you don't, take out a free trial, www.livesquawk.com, and take a free trial out of the macro products. I will put up our two guests' info on social media as well, so you know where to find them. And I'd like to thank you both really for taking part today. Beat Nussbaumer there.
Thank you very much for having me, Harry.
Always a pleasure as ever. And Jeffrey Hirsch.
Yep.
Thank you very much for your involvement today. Just to give you a quick bio, Jeffrey Hirsch, CEO of Hirsch Holdings, publisher of Almanac Trader, editor of Stock Traders Almanac, and Beat Nussbaumer, founder and CEO of Macro Beat, an FX macro trader, researcher and FX tutor. So I'll put them out there, find them out there, look at what they do, because it's invaluable for traders really, and investors alike. So thank you both, and anyone else, good luck trading the number.
Thanks, Harry.
Thank you very much, guys.
Thank you, Harry.
Cheers.